Hey guys, welcome back. Today I'm going to talk about 5 concepts that you need to know before you start investing. And I'm going to cover them in 3 minutes, so watch this timer and make sure I stay on track. Ready, set, go. Number 1, investment vehicles. What people can invest in with their money. I'm going to give you an overview of 5 of these. Stock, share, equity. This is a piece of a company that you can buy. If a company offers 200 shares and you buy 2, you own 1% of the company. A stock's value is determined by how investors value the company and whether they're buying or selling the stock. Historically, stocks have been the most profitable investment vehicle because they are the most risky. Bonds, fixed income securities. A bond advertises its interest rate and maturity date so that you know how much you're getting paid and when. Because of this certainty, bonds are a lot less risky than stocks, but it also means that there could be less return. Mutual funds. A mutual fund is a portfolio of stocks, bonds, and other securities that are bought by the pooled investments of the investors in it, and they're managed by money managers. It can be passively or actively managed. Actively managed funds try to outperform the market, but they don't always succeed, and they can come with a lot of fees. Mutual funds are good because they give investors with limited funds access to diverse portfolios, but they can be kind of heavy on the fees. Index funds. An index fund is a type of mutual fund that tracks a market index such as the S&P 500. These are passive funds and usually have lower management fees. ETFs, or exchange traded funds. ETFs are traded like stocks and track index funds, bonds, and more. ETFs were created less than 25 years ago, so they grew up with my and probably your generation, and they're popular among college students and millennials because of their low fees and their ease to trade. Time for a little R&R. Risk and return. Risk is the uncertainty behind your investment. Risk can come in different forms, including market risk, default risk, country risk, and company risk. New businesses are very risky, while older, bigger giants such as Amazon and Google are much less. Some investors, called venture capitalists, enjoy the thrill and the risk of investing in new businesses. This graph shows that when you take more risk, you will have greater returns, but it should also show that when you take a lot of risk, you might have great losses too. Diversification. Diversify your portfolio. In other words, invest in many different investment vehicles. Make sure your stocks are spread across many sectors and in companies of many different sizes. Diversification is crucial for sustainable success and reduction of risk. Sometimes a shock will affect one company negatively and another company positively, and so the idea is that your portfolio will remain constant even though individual stocks are going all different directions. Remember that you cannot control a certain amount of market risk with diversification. And that's okay. Fees. They will creep up on you. Brokers charge trading and account management fees. All funds, including ETFs, have fees for the privilege of investing in them. If you're not careful, fees can eat up your investment profits. Don't let it happen. Compare trade commissions and different fees at various brokers before you choose one. Dollar cost averaging. This is a fancy term that simply means that if you invest for the long run, the ups and downs of your investment over time will average out. Woo, we made it. I don't know if I made it, but I tried. I hope this crash course helped you get started with your investment journey. If it did, please share with your friends and family. I have a blog post that goes a little bit more in depth into these topics, and I put a link in the description. Everybody can invest. You and I can invest. You don't need to be a Wall Street tycoon. You just need to know how to protect your money.